Imagine waking up one morning and discovering that everything you thought was safe in the stock market has suddenly become dangerous. Imagine the companies everyone believed were too big to fail collapsing overnight. Imagine entire portfolios built over decades evaporating not because of a slow decline, but because of a single unexpected event, a black swan. These are the moments that separate the financially secure from the financially destroyed. And today, we're going to learn how Charlie Munger, Warren Buffett's brilliant business partner, avoided disasters that blindsided almost everyone else. Munger didn't build his fortune by chasing the next exciting stock. He built it by protecting himself from the unexpected, from the events nobody thinks will ever happen until they do. So let me ask you, do you feel protected? Or are you one market shock away from panic? Because here's the truth, black swans aren't rare. They happen more often than people think. The dot-com crash, the 2008 financial meltdown, the pandemic market crash, each time millions were caught completely off guard. The people who survived and thrived weren't lucky, they were prepared. And that's what this video is about. You're about to learn how Charlie Munger protected his money from the unpredictable. And once you understand his approach, you will never look at risk or investing the same way again. So let's go into the mind of a man obsessed with avoiding stupidity, minimizing danger, and building a portfolio that can survive hell itself. Munger believed that the biggest risk in the stock market isn't volatility, it's ignorance. He said the first rule of compounding is to never interrupt it unnecessarily. The fastest way to interrupt compounding, losing big, one catastrophic loss can erase years of progress. That's why Munger played a different game than Wall Street. The goal wasn't to get rich fast, the goal was to never go broke. Munger would look at an investment and ask a simple question. How can this blow up on me? Because while everyone else wants to know how much money they could make, Munger wanted to know how much money he could lose. He knew that most people fail not because they choose bad investments, but because they ignore the hidden risks. They assume today will look like yesterday. They assume the market will always recover. They assume the world is predictable. But black swans live in those assumptions. Unexpected events don't announce themselves. They show up, they destroy, and they leave only the prepared standing. Munger understood that humans are wired to underestimate risk. We trust patterns, we assume stability, we mistake good luck for intelligence and rising markets for personal skill. Until one day, a single domino falls and then everything collapses. Munger didn't want to be one of those dominoes, so he built layers of protection. The first layer was discipline. He refused to invest in businesses he didn't fully understand, no matter how popular they were. While others chased dot-com startups in the late 90s, Munger said no. While others rushed into crypto and meme stocks, he would have said no. He didn't avoid these investments because he couldn't see the upside. He avoided them because he saw the downside too clearly. To Munger, if you can't predict how a company makes money in the future, you're gambling, not investing. And gamblers get wiped out. He said the big money isn't in the buying or the selling, it's in the waiting for a great business that is so solid, so understandable, so durable that even a black swan would struggle to kill it. Think about that for a second, an investment that can survive chaos. How many companies do you own today that could handle a global shutdown, a supply chain crisis, the overnight bankruptcy of their biggest customer, a sudden shift in technology? Most investors don't think about these things until it's too late. Munger did, because he understood something crucial: good times hide weakness. When the economy is roaring, bad companies look good, bad business models look smart, bad decisions look profitable, and weak investors look like geniuses. Then when the storm hits, the truth comes out. Munger didn't want to discover the truth when the storm arrived. He wanted to know before he put in $1. That's why he demanded a margin of safety. If a business is worth $100, he wants to buy it for $6 or $70. That way, even if he's wrong, even if the unexpected happens, there's room for safety. There's a cushion. Risk doesn't disappear, but it becomes survivable. He once said, all I want to know is where I'm going to die, so I'll never go there. It sounds like a joke, but it's genius. He focused not only on winning, but on eliminating the ways to lose. Every investor should ask themselves, where could this investment die? What could destroy it? Competition, technology, debt, corruption, a lawsuit, government regulation, a change in consumer behavior. If the answer list is long, Munger walked away. The opportunity cost of a missed investment is tiny compared to the cost of a catastrophic loss. Now let's talk about something most investors completely ignore: concentration versus diversification. For decades, investors were trained to diversify. Spread your money everywhere. Protect yourself by owning a little bit of everything. But Munger had a radically different approach. The idea of excessive diversification is madness. He argued that diversification protects you from ignorance, not risk. And Munger refused to be ignorant. He said, if you really understand a great business, why would you want to own 20 mediocre ones? Why dilute your best ideas? He preferred a small number of world-class companies, each chosen with extreme conviction. But wait, doesn't that increase risk? Not if you choose correctly. Not if you understand the business so deeply that you know it will still be here in 10, 20, 50 years. Coca-Cola, Apple, these aren't lottery tickets. They are enduring machines that print cash. That's why Munger concentrated, but only in companies built to survive. Black Swans, companies with strong balance sheets, sticky customers, durable competitive advantages. He didn't invest in fairy tales. He invested in inevitabilities, because inevitable companies are the hardest to kill. So now you're thinking, how do I know which businesses are sturdy enough? Munger had an answer. You judge a company not in good times, but in crisis. Anybody can look strong when the wind blows in their favor, but only the truly great can stand when the wind turns into a hurricane. Munger loved companies that continue to produce cash even when the world feels like it's falling apart. Businesses with low debt, because high debt means death when the unexpected hits. Businesses with pricing power, the ability to raise prices without losing customers, because inflation is a black swan for the weak. Businesses run by smart, honest managers who think long-term and don't play accounting tricks to hide problems. When chaos arrives, leadership matters more than profits. And speaking of chaos, Munger embraced it. Not emotionally, intellectually. He built mental models to explain why the world behaves in unpredictable ways. He studied history. He studied psychology. He studied biology, physics, engineering, everything. Because black swans come from everywhere. Most investors only study the stock market. Munger studied the universe. That gave him an edge. He saw patterns others couldn't. He recognized bubbles forming while everyone else celebrated. He spotted scams disguised as innovation. He avoided what he called the madness of crowds. Crowds will always run toward the shiny object, the hottest trend, the story stock, the sure thing, until it collapses, leaving only tears. Munger stayed rational. He stayed patient. He stayed skeptical. And that's why he survived what others didn't. You see, the biggest danger in investing isn't the black swan itself. It's how you react to it. When the world panics, most investors panic too. They sell at the bottom. They lock in their losses. They transform a temporary problem into permanent damage. Munger trained himself to remain calm in the storm. He said we must prepare our minds for suddenly massive change, because when a black swan hits, the world belongs to those who keep their heads. Let me share something powerful. Munger believed that resilience is a choice. You can build a portfolio that expects perfection, or you can build one that expects reality. Perfection feels good until it dies. Reality feels conservative until you realize you're still standing while others fall. That's the ultimate goal, survival. If you survive long enough, you win. If you avoid the disasters, wealth will eventually come. because compounding works miracles, but only for those who refuse to let it be interrupted. Munger never pretended he could predict the future. He knew his limits. He knew that certainty is an illusion, and that confidence can be dangerous. He preferred humility over hype. He said, "It's not supposed to be easy. Anyone who finds it easy is stupid." That might sound harsh, but it's a warning. Easy money is usually fragile money. Wealth built slowly with discipline and patience has roots deep enough to survive storms. So how do you apply this wisdom to your life? You start by asking better questions. Not, will this make me money? But what risks am I not seeing? What assumptions am I making? If I'm wrong, what happens? You build a portfolio that can take a punch. Cash reserves, so you never have to sell during fear. High quality companies, so you don't worry about them disappearing. Reasonable expectations, so you aren't seduced by dangerous fads. Education, so you never rely on luck alone. Munger always said the best way to prevent disaster is to avoid stupidity, not cleverness, stupidity. Avoid companies drowning in debt. Avoid management that overpromises. Avoid industries you don't understand. Avoid investments where survival depends on everything going right, because life doesn't go right forever. Black swans don't care what you believe or what you plan. They don't care about your dreams or your timeline. They come when they want. The question is, will you be ready when they do? Let's take a moment and reflect. Think about the last financial crisis you lived through. Did you panic? Did you sell? Did you wish you had more cash? Did you discover that some of your safe investments weren't so safe after all? Those moments are lessons. Munger learned from every scare, every mistake, every storm he survived. Most investors don't learn. They move on. They forget until the next disaster wipes them out again. Don't be one of them. Become the kind of investor who remains wealthy not because the world behaves, but because you don't depend on it behaving. Charlie Munger didn't chase Black Swan predictions. He protected himself from their impact. That is the essence of intelligent investing. You don't need to know the date of the next crash. You don't need to predict which company will blow up. You just need a portfolio built to handle surprise. That is how fortunes last. That is how generational wealth survives across decades. And that is how you take control of your financial destiny. So now I ask you, what will you do after this video ends? Will you continue investing the same risky way everyone else does? Or will you choose to step into the mindset of Charlie Munger, a mindset where patience is power, where caution is intelligence, where survival is success? The market rewards those who stay in the game longest, and the ones who stay in the game are the ones who avoid disaster. Let this be your reminder. You don't have to be brilliant to achieve financial freedom. You just have to avoid being foolish. Protect yourself. Question everything. Respect risk. Value durability over excitement. Build a portfolio that can survive hell, because one day it might have to. And when that day comes, you want to be among the few who are prepared, calm, and ready to take advantage of opportunity while others panic. This is how Charlie Munger protected his wealth from black swans. This is how you can protect yours. Patience, prudence, preparedness. When others gamble with their future, you will secure yours. When others collapse in chaos, you will keep compounding. When the unpredictable strikes, you will still stand. That's what Munger would want you to do. Not to become the richest fast, but to become the smartest long term. If you found value in this mindset, if you want more teachings inspired by Charlie Munger's legendary wisdom, then make sure you subscribe and stay tuned, because we're just getting started. Wealth is built by those who think differently. And now you are one of them. And let's continue with something Charlie Munger valued more than most investors ever realized: liquidity. Because when the world turns upside down, when markets fall like dominoes, when fear takes control, the most powerful position you can be in isn't owning the hottest stock, it's having cash. People call cash lazy. They say it doesn't earn enough. They say it just sits there doing nothing. But Munger saw cash differently. He saw cash as survival, as opportunity, as freedom. He once said, "We don't want to be like the guy who was just a little short of cash when opportunity came along." And isn't that how most investors behave? They rush to put every dollar into something, stocks, crypto, real estate, anything, because they can't stand seeing cash in their account. They fear missing out. They think if they're not fully invested, they're doing something wrong. But here's the irony. It's the ones who keep cash on the sidelines who are positioned to take advantage when everyone else is forced to sell. Black swans don't just cause losses. They create the greatest bargains of a lifetime. When fear floods the market, asset prices disconnect from reality. Wonderful businesses get sold like they're failures. Strong companies become cheap because investors need cash fast. And who buys during those moments? The ones who already have cash, the ones who planned ahead, the ones who understood that liquidity isn't a waste, it's insurance. Munger watched investors panic in every crisis he lived through. The smartest minds turned into emotional wrecks because they were trapped, overinvested, over-leveraged. Forced to sell their best assets at the worst possible time. They didn't lose because the companies were bad. They lost because they didn't have the liquidity to survive the downturn. Cash is what prevents a temporary drop in price from becoming a permanent loss in wealth. Think back to 2008. Think back to March of 2020. How many people would have become wealthy if they simply had the cash to buy great companies at a discount? How many missed life-changing opportunities not because they lacked knowledge, but because they lacked liquidity? Munger never wanted to be one of those regretting the opportunity of a lifetime because he was fully exposed. So he and Buffett always kept billions ready. Not because they loved cash, but because they loved being able to strike when the market handed them a gift. And here's another truth: liquidity protects your mind. When you have cash set aside, fear doesn't control you. You don't look at market drops as threats, you look at them as chances. Suddenly, chaos becomes exciting instead of terrifying. Panic becomes profit. You don't feel pressure to rush. You don't make emotional decisions. Liquidity gives you patience, and patience gives you power. Most investors underestimate the psychological benefit of knowing they can hold through any storm. But Munger understood the mind is the real battlefield of investing. If your thoughts aren't stable, your returns won't be either. Cash creates calmness. Calmness creates rationality. Rationality creates wealth. That's why Munger always made sure Berkshire had a strong cash position. It wasn't an accident. It was strategy. He said, "We're never so stupid that we're forced to do anything." That is liquidity. It means no matter what happens, you stay in control. You choose when to act. You're not pushed around by interest payments, margin calls, or desperation. You get to think. And in investing, thinking clearly when everyone else is losing their minds, that's where the real edge is. Let's look at it another way. Imagine you're crossing a desert. Most people pack just enough water to make it based on the average weather conditions. It's efficient, it's optimized, and it works until the temperature spikes just a little. Then they're done. Munger, he packs extra water. Sure, it slows him down a little in the beginning, but when the unexpected happens, he keeps walking. Everyone else collapses. In the stock market, cash is that water. It looks unnecessary until the moment it becomes essential. Liquidity also protects you from becoming a forced seller, and a forced seller never gets a good price. When investors use too much leverage or stretch their resources thin, even a small downturn can trigger margin calls. Suddenly they must sell, not because they want to, not because it's smart, but because they have no choice. And here's the evil twist of markets: forced sellers fuel crashes. Their desperation becomes someone else's opportunity. Munger made sure he was always the one buying from the desperate, never the desperate one selling to the buyers. Now, some people hear this and think, but I don't have millions in cash like Munger. And that's the wrong way to look at it. Liquidity isn't about the amount, it's about the habit. It's about the discipline to always keep a percentage of your portfolio ready. It's about building a rule into your financial life: never stretch yourself thin. Never assume good times will last forever. Always have enough dry powder to stay calm under pressure. Even in personal life, liquidity matters. Emergencies hit, surprises come. People who live paycheck to paycheck with no savings aren't just financially fragile, they're emotionally fragile. And investing while emotionally fragile is like flying a plane while terrified mistakes become almost guaranteed. Cash gives confidence. Confidence gives clarity. And clarity makes you make better decisions everywhere, not just in markets. Munger knew that liquidity isn't sexy. Nobody brags about their cash position. Nobody posts screenshots of their emergency fund. But the investors showing off their gains in good times are usually the same ones who quietly disappear when the downturn comes. The real winners are the ones still buying when everyone else is crying. Think about what liquidity really represents: patience, preparation, respect for uncertainty. It's the acknowledgement that black swans can strike any time. It's accepting that you cannot predict, but you can prepare. Munger built his empire on that mindset. He didn't rush, he waited. He played the long game. And when opportunity came disguised as disaster, he was ready to act while others froze in fear. Because opportunity doesn't knock, it crashes the door during a crisis. Most investors are too shocked or too broke to answer. Liquidity is how you stay awake when opportunity shows up. It allows you to turn unpredictability into profit. It transforms disaster into destiny. And it keeps you standing strong when the world falls apart around you.